On today's episode, we are going to take a look at 3 companies reporting earnings this week. So let's get started. Like I said, today we are going to take a look at 3 companies, and those 3 companies are going to be Groupon, Oracle, and Carmax. All 3 of these are going to be reporting earnings this week, and how this episode breakdown is going to go is we're going to take a look at the price performance for these companies. We're going to take a look at past historical revenue growth, margin growth, their balance sheet, cash flow operations, and then just a quick way of how the whole COVID-19 has affected these businesses. So I hope you guys enjoyed the episode. Like always, guys, before we continue, make sure to hit the subscribe button, the thumbs up, and the bell. It helps the small channel out so much, and I truly appreciate the support. Also, let me know in the comments right now if there's any of these 3 companies that you guys want me to do a full in-depth analysis. You're gonna see today we are gonna get real deep into the companies, but this is nothing compared to what I do when I take a full look at a company. So if you guys want me to look at their earnings, feel free to let me know in the comments below. Like I said, the 3 this week that I'm kind of excited to see would be Groupon, Oracle, and Carmax. But if there's any other companies, feel free to also let me know on the comments. And if you guys don't know, my name's Jose Najarro. I've been investing for about 7 years, and I've been constantly learning about the market. I have tons of experience, constantly a student of the market. I am very bullish in the following sectors: semiconductors, data, clouding, esports, and e-commerce types. So most of my portfolio is built around there. My latest video was me talking about my top 3 esports companies, so feel free to check that one out after. I promise there's so much information there that I'm sure you guys will enjoy it. Alright, so the first company we're actually going to take a look at is Groupon, and Groupon has actually been pretty active lately, and it has been trending for some time. The major thing is this company's price jumped all the way up to $21.75, when just a month ago this company was trading at about $1. So many people are wondering why this company jumped about 20 times its price weight just about a year ago, about a few months ago. And the thing is, no, the company's price did not change. There's something that happened where it's called a reverse split stock, and that's pretty much happens. Let's say you have 10 stocks at $1, right? So instead of having 10 stocks, the company does is it reduces for every 10 stock, you now get 1 stock. So if 10 stocks were worth $1 each, now 1 stock, when they reverse it, that 1 stock, since is now equal 10 stocks, will be equal to $10. But at the end of the day, the company is still worth the same. It's just the stock price that's changing. But let's say if you were holding 100 stocks, it would now go down to 10 stocks. So that's pretty much just what happened with Groupon. In Groupon's, it wasn't a 1 to 10, it was, I think, a 1 to 20. So for every 20 stocks you had, you would only get 1 stock back. But again, the price of those stocks changed throughout there. So it's not like you really, in theory, you're not losing money at all, and in theory, you're not making money at all. But usually the market reacts a little different to it when things like this happen. So let's take a look at Groupon since its all-time high, since its highs in February 18th. Compared to the price it ended now, this company is down about 64%. And it's something we're going to see, right? A huge reason that COVID-19 has affected Groupon. Groupon is well known for being like that local market server where they sell discounted prices to local vendors. And right now, with pretty much in the United States, the whole place closed down. Not many people, I'm guessing, are going to local vendors, to getting a massage, to going to do some form of event. So that has definitely brought down the excitement towards the investment in companies like Groupon. So now I'm on this amazing website, lazyfa.com. Right here, I'm going to take a look at revenue growth, and then we're going to take a look at margin growth for the company. In the past 3 years, this company's revenue continues to decline. In 2019, it saw a decline of about 16%. In 2018, it saw a decline of about 7%. And in 2017, it saw a decline of 5.6%. For any company, this is not something you want to see, right? You never want to see a decline in growth. That's always a big red flag, and we can see it has been happening for at least the past 3 years. Now we take a look at this company's gross margins and profit margins. One cool thing that I did not think we were going to see is gross margins does seem to be in an uptrend. But profit margins is the complete opposite. Profit margins last year for 2019 were negative 1%. So this company was actually losing money last year in 2019. In 2018, it was actually negative 0.4%. And in 2017, it was 0.5%, barely breaking even. But we can see there is a decrease in profit margin. So you can see, right, many red flags were shooting up about Groupon and how it was turning to be a bad investment. The first was the decline in revenue growth. The second thing was the historical decline of profit margins as well. All right, so now let's take a look at this company's balance sheet, and this is from their most recent quarter. Here, this company at the end of last quarter had non-current debt of $325 million, and it had cash and cash equivalents of about $750 million. So that's actually a pretty good thing, right? This company has enough cash and cash equivalents to pretty much pay off any long-term debt. So obviously, if you just, to me, the balance sheet is the best way to understand how a company is doing. And the income statement, right? The income statement tells you, hey, are you increasing your income coming in every year? And if you see an uptrend in income increase, that's obviously a good thing. When you see a decrease in income, that's obviously a bad thing. The second thing, a balance sheet, if you have enough cash or enough money in your bank to pay off your debt, obviously that you're in a great place, right? So it's very similar when you look at a company. You just have to think of how you look at your finance. Obviously, the names are sometimes a bit different, that you might have to learn about the names, but the overall way to really look at a business, it's pretty much like looking at your finances. So that's why I really enjoy taking a look at companies. So like we said, right, this company has plenty of cash to pay off its non-current debt. So for a balance sheet perspective, this company is in a great place. Again, for an income statement place, this company is not in a strong place. So at the end of the day, you have to take a look at everything to really see the great picture. Next, let's take a look at this company's operating cash flow margins. And the operating cash flow margins is the net cash flow from operations. So this is how much money this company keeps from its everyday activities. One thing is, as this is actually decreasing, and that's obviously a bad thing. So for example, for 2019, this company had operating cash flow margins of 3.2%. So for every $100 this company did on sales, it only kept $3.20 on its sales, right? That's regular money that goes on its operations. And that's actually pretty bad, right? Imagine selling a $100 product and only keeping $3 out of it. The other thing that we're seeing it's bad is this margin is continuing to decrease. At one point in 2014, margins were up at 10%. So right now, things are not really looking that good for Groupon. Let's take a quick look at this company's most recent earnings, which they reported in February 18th. This was for the quarter that ended December 31st. So this was pre-COVID-19. Pre-COVID-19, this company's revenue was down 23% compared to the same time last year. So I can't imagine how much worse it's going to be for this quarter where they're going to report, which is going to be probably till the end of April, maybe till the end of March, when it was pretty much all of COVID-19. So one thing though is if we take a look at Groupon at its current state right now where it's at, it really looks like a bad business. And that's why the stock price is so down, right? It has been beaten up even before COVID-19. If we take a look at the price in the past year, this company has dropped about 70%. So, right, this company has taken a huge hit. So Groupon, where it's at now, is not a place I would like to invest. But Groupon, in their last recent earnings, they mentioned that they're doing a whole complete turnaround of their overall business, where they want to become more of a local type, where right now, if you go to Groupon, what you see is you see a lot of local vendor stuff, but you also see a huge spam of different e-commerce items. So it looked like Groupon was trying to do two different directions. What they're trying to do is take away the e-commerce objects and just really much focus on the local experience. And this is something that not many, there's a few competitors, right? We can think of, what was the some competitors, I think TripAdvisor might be one of them, but this is really what you really want to go into a full in-depth local market here. And that's what Groupon is trying to do. They're going to create a new application. And really focus in that type of market. And I think that's where Groupon, like when I think of Groupon, that's what it should focus on, right? When I don't think of Groupon as a place where I'm gonna go buy some 3 pairs of sunglasses for $30 or something, right? That's not what I've ever used Groupon for. So for them to move into something like this, I think is in the right direction. The question is it too late? And the question is, how has COVID-19 really delayed this process, right? Because now with COVID-19, a lot of people are not going out, so that even though this is I think it's a right direction, it might be a right direction at the wrong time, right? Just the overall market of where we're at right now will not really help this company out. So this is my current thoughts on Groupon. I do think if they could turn around, this could be a great story. This could be one that, hey, Groupon was that company that was failing, that if they do turn around, it can be a great success story for investors. But of course, with stories like that, they are very, very risky. So I can't wait to see earnings for this company this week to see how they have reacted with everything. And then just one thing I want to mention, right? Many people don't take a look at their 10Q report or the earnings release that companies that do. And here, this is something they released in February 18th. And they mentioned that there was a reverse stock split proposal. So it's not like this reverse split was new, right? These stuff like this are planned ahead of time, and we can tell that if you look at stuff like this, you can really see what's going on within the business. All right, the next thing we're gonna take a look at is Oracle, and Oracle has actually been a company I've actually just started to get really interested in. And my main reason for it is I've been looking at a lot of cloud companies that do CRM, customer relations management, companies, and for example, Salesforce is one of them. It's one of the major ones in there. And a lot of clouding computers are now, some of the new clouding computers out here that are going up in price ridiculously are companies that deal with CRM, companies that deal with HRM, human resources management. Oracle has actually been a company that every time I look for a competitor I look at competitors for those cloud companies, Oracle always makes the list. So that's actually something I did not know. So Oracle is dealing with cloud CRM, cloud HRM, all types of cloud services for enterprises. So I would have expected Oracle to be actually doing pretty good. But if we take a look at since February 20th, when the market started tanking, this company is actually down 6.5%, which to me, I find odd, especially due to the type of market Oracle is in. But now let's take a look at this company's historical values and see maybe why this company is not as increasing as the other companies. And one thing, right, those other companies we have seen, those other cloud companies are increasing at a 40% growth rate. So let's take a look at Oracle now. All right, so first let's take a look at Oracle's revenue growth. Next, let's take a look at this, and then we're going to take a look at this company's margins growth. But remember, guys, if you guys are liking the content, make sure to subscribe and make sure to let me know in the comments which company you guys want me to do next. So revenue growth for Oracle in 2019 was 0.3%. In 2018 was 4%, and in 2017 it was 2%. So now I can see why many people are not too excited about Oracle, right? This company is growing at a low single digits, and that's something that, hey, right now we have big companies like Google, Microsoft, Apple, Amazon, all growing revenue at about a 20%. So if big companies like that, it's not exciting to see a revenue growth in the single digits. Next, let's take a look at this company's margins, and then we'll jump into the balance sheet. So here, one thing I can see is this company is a very, very stable company. Gross margins for the past 10 years has been above between 75 to 80%. Right now it's sitting at 79.8%. The same can be said about profit margins. They are a bit of loops up and downs, but again, there's certain expenses, but on average, this company's profit margins is between 20 to 30%. In 2019, it was 28.1%. So this is a company that is actually making money for investors. does it have it actually even has a dividend, right? Something most growth companies don't have. But we can see Oracle is not a growth story. Next, let's take a look at Oracle's most recent balance sheet. And after this, we'll take a look at their operating cash flow margins. The first thing I want to see is this company has cash of about close to $24 billion in current investments of about $2 billion. So this company has quick cash of $26 billion, give or take. Then let's take a look at this company's current debt. Current debt is debt that needs to be paid off in the next 12 months. It has $2.3 billion of that. That to me is okay, right? That's not a lot. This is about a little less than 10% of what this company has in cash. So this company has enough cash to do that. The next thing is this company has non-current debt of about $50 billion in debt. And like I said, right, every time we take a look at a company, we have to understand what type of state they're in. We took a look at Groupon previously. We saw that company had a very bad income statement. It was barely making any money. So when we take a look at a balance sheet, we have to be a little more strict. Oracle, on the other hand, is a company that's making a lot of money, right? It has a 25% profit margins. So to see non-current debt bigger than cash and cash equivalents, that to me is okay, right? Just like me, right? I have plenty of cash in the bank, but I have a very big, not very big, but I have a nice amount of non-current debt on my mortgage. But to me, just because I have more non-current debt on my mortgage than I do of cash, it doesn't mean my finances are exactly bad. My income continues to increase. The amount of savings I do continues to increase because I'm paying down some debt. So my profit margins are doing better. So to see non-current debt being a lot higher than cash and cash equivalents for a company like this that's making steady money every year, it's not a bad thing, right? So for me, this is an average balance sheet. It's not something I would fail, but if I was to give it a grade, just due to everything else we know about this company, it would be sort of like a B minus C plus. Now let's take a look at this company's cash flow. Operating cash flow margins has been pretty stable at 36%, right? Completely different level from Groupon. So for every $100 that this company does in sales, $36 go back to its operations, which I think it goes from operations. So I think that's actually pretty strong. That's something I definitely like to see, and we can see why we were a bit more lenient on this company's balance sheet. Now let's take a quick look at where Oracle makes its money and how COVID-19 might have affected. So here we have on their most recent earnings, I have highlighted 83% of this company's total revenue comes from two services: cloud services and licensing support, and cloud license and on-premise license. So anything right now with cloud services has continued to increase. At the end of February 29th, this was still pre-COVID-19, they were seeing small increase, 4% in cloud service and license support, and 2% decrease in cloud license. So I do think due to COVID-19, especially for this upcoming quarter, we might see a stronger growth than average, but still this company is not really growing that much. Total revenue in this most recent quarters only went up 2%, which was very similar to what this company's overall revenue growth seems to be, right? 4%, 0.3% and 2% in the past 3 years. But like I said, it could actually be, I would be pretty excited if this company actually reports at least double-digit growth in these clouding services, but I'm not sure how likely that is. But obviously with COVID-19, things like this can actually happen. The other 20% of this company's revenue comes from hardware and services, something that I don't think we're going to be affected much due to COVID-19. The two major I do think are going to be those clouding service sectors. All right, and the last company we're going to take a look at is Carmax. And Carmax is America's largest used car retailer and a Fortune 500 company. Carmax, if we take a look from February 20th, this company is actually down 11.7% To be honest, this is actually a lot higher than I would have anticipated due to COVID-19. I think the last thing people would be doing is buying cars, but it does seem like I might be wrong because the market believes that right now buying cars is probably one of the best investments if this company is only down 7%. One thing CarMax is doing, I know they have changed kind of their structure of how they're selling cars. They're doing kind of like contactless purchase. They're also doing similar things to Carvana, where they kind of do delivery without you having to even set foot in the store, or even having to talk to anybody. You can do everything from your home. I do think this is actually I wouldn't say a weird thing, but just to me, I'm kind of a car guy, so I like to test drive the car before driving it. So something like this is not something I would be interested in, and maybe that's where my bias is coming from of why maybe I think this should have been a lot lower. But let's take a look at this company's revenue growth, and next we're going to take a look at this company's margins. And like I keep saying, guys, if you guys like the content, make sure to hit the subscribe button and let me know, do you guys want me to do CarMax in its earnings on Fridays? But now let's take a look at revenue growth. In 2020, this company's revenue grew about 11% compared to the previous year. In 2019, it grew 6.1%, and 2018, it grew 7.8%. And you might be like, Jose, why does it say 2020 December 31st? This all depends on what they call the fiscal year. So 2019 might have been their 2020 fiscal year. So that's just the thing, right? The dates don't really matter. It's just sometimes fiscal year for different companies are on certain dates. But still, on the most recent year, this company actually grew 11%. So hey, this is actually doing not as bad as I thought it would. So now let's take a look at this company's gross margins and profit margins for the past 4 years. One thing we can see, right, both these margins seem to be pretty steady. They don't seem to be increasing or decreasing at any rapid rate. Gross margins this past year were 13.4%. Profit margins were 4.4%. You can see, right, the car market, the automobile market has very low both gross margins and very low profit margins, especially because you are buying a vehicle already, and those vehicles are already pretty expensive, and you're only selling them for a bit of a markup price. All right, so now let's take a look at CarMax balance sheets. Then let's take a look at this company's cash flow operations margins. So here, non-current investment. This company, actually, let's take a look at just quick cash. So this company has cash and cash equivalents of $539 million. No current investment. That's actually pretty low amount of cash. Next, this company has current debt of $464 million. So one good thing, this company has enough cash to pay off any non-current debt. This company does have a huge portion of non-current investment and a huge portion of non-current debt. And to me, both of these are probably their cars that they're counting as some form of both liabilities and assets, right? These companies probably have huge inventory that they're putting a lot of debt into. That's why they have such high non-current debt. To be honest, this is a balance sheet I am nowhere near happy to see. This is one that if I was just to look at this, I would not stay full. I personally would not get into CarMax, especially seeing after those very low profit margins of 4% and very even low gross margins. Not a company that I would invest in again, but there's different people, there's different investment styles. Even though for me, it's not a company I would like, it still could be a good investment, right? So never let one person change your mind about everything. Here, I'm just trying to give my opinion and within the facts that I see. But there's always, even if I try not to, there's always going to be some form of bias given, right? It's just the way humans work. I'm trying to look at the best of the numbers, and just based on these numbers, these are not something I would personally get into. Next, let's take a look at this company's most recent operating cash flow margins. And for this most recent years, it was actually negative $1.16. for every $100 this company actually sold, it actually lost about $1.16, which is something I would again something I personally would not like. But I know there's plenty of analysts out there. I think JP Morgan was just pretty bullish on this company and gave it a over $100 price target. So like I said, I'm not too familiar with the car market world. Maybe I'm just not seeing what others are seeing. If you guys are seeing something else, let me know in the comments below. I definitely like to learn others' opinions as well about what they feel about Carmax. Carmax most recent earnings that happened in April 2nd for their earnings, they reported a 15% year-to-year growth. So that's one thing I do see, right? This is definitely a growth company. It's growing at a very strong double digits. The other thing we're going to take a look at is, like I mentioned, Carmax is doing different programs to help out with the pandemic. And now I pretty much wanted to take a look at where this company makes its money from. So to be honest, I thought there might have been like some form of secret sauce that Carmax had, but no. Carmax's main form of revenue is used vehicle sales, wholesale vehicle sales. Those are the two biggest portion of this company's revenue. They make sales out of like extended protection plans, but that's pretty small. So there's not much there. Yeah, so there's no other form of revenue, and still the most money this company makes comes from gross profit comes from this company's used vehicle sales, followed by wholesale vehicles. So that's it, guys. That's the three companies I am gonna keep an eye on. If you guys want me to do an earnings on any of them, make sure to let me know on the comments below. Take care, guys. Have a good day, and see you tomorrow with my quick daily news of what happened around the market. And tomorrow is actually Monday matches. This is a day when I actually put two companies against each other. I've done Alibaba versus Amazon. I've done Alibaba versus JD. I recently just did EA Games versus Activision. So tomorrow, I think I'm doing Apple versus Microsoft. I'm not 100% sure, but let me know what you guys, let me know. Make sure to watch that, right? So take care, guys. Have a good night, and see you next time.